Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat.
Chicago wheat. The main activity here during the summer had been the fall below the significant neckline extension, currently at 659, of the small October 2020 to November 2020 head and shoulders top, which you can see highlighted on my daily chart in dark blue. This neckline has a fairly wide congestion area clustered around it, formed from late April to mid-July 2023, from about 609 up to 679, including the gold-coloured long-moving average, currently at 633, and the mauve-coloured medium-moving average, currently at 606. It had been this congestion area that had pressed down on top of the rallies throughout September, October, November, and December 2023, and now into 2024. A little while ago, I'd pointed out the cat's ears pattern over June and July. In essence, this is a double top formed in an overall downward moving market. The potential below for the cat's ears pattern is at target X2 in the 502 zone. However, before even looking down that far, it's worth looking nearer at the interesting looking supports, notably and also this is on a closing basis, notably the May 2023 low at 587 3/4, which is just below the March 2021 low at 592. Then we have the September 2023 low at 570, plus the December 2020 low at 566, and again, this time only on a pure low market basis, we have the September 2023 low at 570. Now, in November 2023, we saw prices punch down through these, punching down as far as just below the December 2020 low at 566, but failing to make the key requisite 2 consecutive closes below it before storming back up, with a weekly key reversal up at the end of November 2023. This move up pushed up through moving averages as far as the capping long moving average overhead, where it stopped after trying twice, possibly 3 times, before in January this month, heading lower again. The bright red highlighted March 2022 to date downtrend, currently at 609, initially helped push prices low, though it has now been challenged. Looking ahead and above, well, we obviously have the long moving average on top, and once again, after a short hiatus last week, the short medium moving average below. The short medium moving average is currently at 611. The only other feature is what pattern was formed over December last year. Now, initially it looked like a dubious ascending triangle, but I'm more inclined to look at it as a possible double top, if not a very good one. Last week it looked like we might try for the downside targets for the double top, but this week has seen that idea for the moment rejected. However, I would nevertheless place some potentials below for this double top pattern, for a primary target in the 593 zone and a secondary target down in the 570 zone. Now, I had placed these targets earlier. Now, last week saw the primary target reached, but really no more than that, so the harder to reach target X3 is still live down in the 570 zone. Chicago corn. The medium moving average, currently at 495, highlighted in mauve on my daily chart, which you can see, we can just see above the mess of very tight recent ranges, has been an effective cap on this market throughout 2023 since about March, especially back in June, then recently in October, November, and then December 2023. In December last year, when it was penetrated, it still held down the market. Additional to the declining medium moving average, you also have the same old congestion band overhead between 490 to 498, including the 2021 low at 498. The short medium moving average, currently 478, while still pressing down, has untangled itself from the medium moving average. This brings me once again to a more recent factor highlighted in bright red on my daily chart, and that's the July 2023 to January 2024 downtrend. And the flat surface, now resistance below, but was originally support. It's also highlighted in bright red, also since July last year, and that's currently at 470. Now together, they make up a descending triangle, an advanced descending triangle idea that saw the market push below the lower trendline support 2 Fridays ago, and so far not venture back up over it. To clarify my thoughts on this move, I'd refer to my comments from 6 weeks ago when I said, and I quote, "The question now is whether the support below will hold or the resistances above. We seem to have some pretty strong overhead resistances, but below the lows formed over the summer around 473. Well, if 473 doesn't hold, well then we have some congestion starting at 463, but it isn't that strong, and I'm concerned that the accumulated ammunition overhead from the descending wedge pattern, the bull channel, and now from the new descending triangle, well, they may punch down through it all fairly easily. For a third week now, which is in reality, it's now for a 10th week, but for a third week now, it all depends on the 473 zone below." End of quote. I'd only add some potentials below for the descending triangle pattern. Thus, an initial target X would be down in the 424 zone, where secondary much harder to reach target X1 below in the 374 zone. Now, target X is doable, but target X1, well, that is off the bottom of my daily chart right now. Kansas City wheat. There is still a lot going on here within a fairly narrow piece of action. Not in price movement, but in a narrow piece of market angle of attack action. To explain, again, 10 weeks ago I highlighted a feature I saw whilst looking at the action since August 2023. It was a descending expanding wedge pattern, currently 541 to 623, which is highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but as I said 8 weeks ago, and I quote, "It does hold merit, and I would look to this pattern for some immediate idea of the move downwards." End of quote. Well, it does hold merit, and it has shown the way lower, but it's now starting to get properly pierced. During its lifetime, I've also seen the development of 2 new patterns, one of which involves the descending expanding wedge pattern. So the first pattern involved the lower trend line, currently at 541, highlighted in dark blue, of the descending wedge pattern. And then the downtrend of the September to November 2023 action, currently at 548, highlighted in green on my daily chart. Now together they make a bear channel located inside the original descending expanding wedge pattern. Then again, if we look purely at the upper and lower dark green trend lines, we've seen a descending wedge pattern that ran out at the end of last week. Now I hope I have ably explained what my thoughts are, and also the 3 main patterns that have been and maybe still are driving the market. 8 weeks ago, we had a break up and out of the green descending wedge pattern based on a weekly key reversal up. However, this move higher ran into the combination of the upper trend line of the descending wedge pattern and the green highlighted declining short medium moving average, currently at 634. They have been intertwined since late October 2023, and for a while, this pair of dynamic resistances held prices down. However, at the start of 2024, they started to separate, and accordingly their combined strength, which was greater than their individual resistances, has started to diminish. Already 2 consecutive closes over the upper trend line, and 1 so far over the short medium moving average. 5 weeks ago, I laid out the potentials topside for the descending wedge pattern. There is a primary target X in the 721 area, and a secondary, harder to reach target X1 in the 775 area. I also asked one question, which is so far still unanswered. So I'll ask it again, and I quote, question it raises is whether the move higher stimulates the action since mid-August, so that's mid-August 2023, since mid-August into being a descending scallop pattern or not. The answer to this, for the moment, is still unobtainable, but of course, will depend on what and how far the market will rise. Top side, we have the 50% Fibonacci line of the big 2011 to 2019 move at 691, and the 50% absolute Fibonacci line at 697. However, the support seen there on the way down was limited, so I am unsure how good a resistance that may become. It may be left up to the declining medium moving average, currently 661. And the December 2014 high at 707 to perhaps show some resistance in any rise. But if prices continue rising as far as the June 2014 high and the 2022 low combination at 748, well then the idea of a descending scallop pattern will have to be reappraised. But a lot needs to happen first before we start seriously thinking about that far up. End of quote. I only add one new observation to these, and that is to consider if the action since November 2023 is a possible double bottom. I am not sure as yet, but a double bottom would fit in nicely with a potential topside for the descending wedge pattern and the bear channel and the descending expanding wedge pattern.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Services International Limited. And here comes the final important bit.